Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics. I'm getting pretty good at saying that, aren't I, Ryan?
You're doing really good.
Yeah, we started these podcasts back in April of this year, so I think this is going to be our 36th episode. I was counting.
Wow.
Yeah, right. And that's Cris. Cris is the deputy chief economist, and of course Ryan's the director of real-time economics. My trusty sidekicks. That diminishes your role, I would say. We are co-hosts, I would say, on this podcast.
Oh, that's an upgrade.
Is that
It
an
is.
upgrade? Okay.
Oh yeah, for sure.
Well deserved, though, for sure. I'm the laggard here for sure. But it's good to see you guys. Are you guys on Twitter? I mean, do you have a handle, Ryan? Do you have a handle?
Sarah convinced me to start one this week.
Sarah Rodriguez.
Mm-hmm.
That's the person who's helped me out for, I don't know, 10, 15
Forever.
years, right? Yeah,
Yeah.
she's great.
She was very convincing. So
Yeah.
we'll see how this goes. I'm afraid I'm going to end up going down rabbit holes.
I know. That's what I was saying today, because the CPI number came out, the Consumer Price Index, and we'll talk about that in just a second. But did a little bit of tweeting, and that just can take you down the rabbit hole, as you say. Yeah, really. And Cris, are you on Twitter?
I did set up a handle years ago, but I never use it.
Okay, well, are you following me? You're not following me. Oh my gosh. You need to follow me, Cris. Get up,
all right.
at the very least, go up there. I don't care if you follow Ryan. I don't care about that. you gotta follow me.
All right, got to find the password. All right.
Oh, and well, of course. Are you at Ryan Sweet? Is that your
No. I don't even, actually, I don't know what I picked. I'll let you know.
You sound pretty nonchalant about this whole thing.
Yeah, I'm just not a social media person. But now, more I think about it, there's no place you can hide now. So I can like subtweet you on Twitter all the time.
Hey, and don't mess up, Ryan. We've got a lot of people reading these tweets. I mean, so I don't mean to make you nervous, but yeah.
Oh no, that makes me really nervous.
Yeah.
But next time you tweet out that we're in the midst of a correction, I'll be right there to tell you.
Okay, very good. Yeah, very good. I was going to say something. Oh, I'm at Mark Zandy.
There we go.
Wow, that was relatively quick, wasn't it? Yeah,
wow.
It took about all but 3 minutes for me to tout my handle. There you go.
Right out the gate.
Please sign up, follow. That's what this is all about, apparently. So please do. Please do. All right, let's get to business. Well, obviously today the number that we need to be focused on is the CPI, the Consumer Price Index. Ryan, why don't you describe what the number, what happened here with the consumer price inflation?
Yeah, I don't think there was a lot of surprises. Energy was a big contributor to the increase. We had rising oil prices, heating costs have gone up. The good news is recently they come back down in quite a bit. So we'll get some relief in December. So I think we've talked about this on the podcast. I think November is likely the worst of the inflationary pressures we're going to experience now. But prices rose across the board. Food prices were up. Take out food and energy, which are very volatile. So looking at core prices, which kind of what's underlying inflation running at, that still was up 0.5 month over month. And is up nearly 5% year over year. So inflation's high, but I think as we talked about, it's only going to get better from here.
So you think November CPI inflation was up year over year 6.8%, the highest since
Correct.
the early 80s. So a long time ago. You're saying that that's the peak, you think?
Yep. And I have a good number. I got a good number for the game.
Oh, for the game. Okay, good.
To highlight this.
By the way, that's what I tweeted. Exactly what you just said, that November was ugly. I used the word ugly, but that was the peak, that we're going to see improving inflation going forward. And, the most obvious thing to point to most immediately is this decline in oil prices, which is now translating into lower gasoline prices, which is key. And natural gas prices are down, right?
They're down a ton. And retail gasoline prices, they've edged lower recently. They're about to drop a lot in the next couple of weeks.
Right. Where are we now on the gallon of regular unleaded at Wawa? Do you know?
356 this morning.
Look at Cris.
356?
Yeah, that will get down to 3.
At least my Wawa. Yeah.
Well, nationwide, I think it's like an average of 3. We pay a little bit more here in suburban Philly, but I think it's 3. Last I looked, 335 nationwide. And the peak
That's
was a few weeks ago, $3.50. And with oil now trading closer to $70 a barrel on West Texas Intermediate, you're saying we're going below $3 a gallon.
Yeah, and it's more, I think you tweeted out the chart, the wholesale gasoline prices, they lead
Yeah.
retail by a couple of weeks, and they point to retail gasoline prices a little bit north of $3 per gallon
Right.
for the national average.
You may not know the answer to this, but I'm guessing you might. And hopefully this isn't what you were going to do for the game. But
Oh,
so say take,
oh no, you're going down that road.
Really?
Take out energy.
Yeah. No, well, maybe let me ask it
All
this
right.
way.
Okay.
So let's say the target inflation rate, where let's say the Federal Reserve wants CPI inflation to be, consumer price inflation, to be, let's say it's 2.5%. I think that's, reasonable kind of target. We're now sitting, let's round up to 7. Okay. So 7 minus 2.5 is 4.5 percentage points. That's what we're above target. Of that 4.5 percentage points, how much of that do you think is energy? And that's gasoline, home heating, the whole shoot and match. Do you have a sense of that?
Yeah, it's 2.5 percentage points.
2.5 percentage points. Okay, so if
in November,
energy, yeah, right. So if energy was just flat, energy prices were just flat, inflation would be, what's that? That would be 4.5%.
Yeah, 4.5.
Okay. And in all likelihood, energy prices are going to fall. Well, we know they're going to fall, so it's going to weigh on it even more.
It's going to be disinflationary. Yep.
Okay, let me ask you this then. And hopefully this isn't what you had planned for the game.
It definitely is.
Oh, really?
No, it's all right. Go ahead. No, this is a good one. I'll come up with a new number.
I'm sorry about that.
No, this is good.
Well,
this is
okay.
I thought it was important.
Yeah, 4.5 percentage points, 2.5 percentage points. 4.5 is the delta, the difference between inflation today and where everybody would want it to be, broadly. And 2.5 of the 4.5 is energy. Check.
Correct.
That's going
temporary.
away.
Yeah.
Temporary.
Energy prices.
In fact, it's going to go the other direction here.
Exactly.
Yeah. Okay, that leaves you with 2 percentage points to explain, right? Right. So, of the 2 percentage points, how much of that is vehicle prices?
Oh, I didn't do that. So what I did is I looked at all supply constraint components.
Okay.
So that's new and used vehicle prices. That's all audio equipment. So when we add up all that, and most of it is used car prices.
Right.
That in November added 1.8 percentage points. So my number was going to be my number was going to be 2.5. And that's the year-over-year increase in the CPI if you exclude supply chain issues and energy. And at 2.5 is exactly where the Fed would want the CPI to be.
Okay. So you're saying that all of the difference between where we are today and I rounded to 7, but actually 6.8. So you were more precise. So you're saying 6.8 versus 2.5. That can be explained by two things. One is the energy prices, gasoline prices, home heating primarily, and the other is those prices for those products that have been disrupted by the global supply chain issues that the Delta variant kicked off back in the summer.
And to be completely transparent, here's the list of supply constraint components that I used. New vehicle prices, used vehicle prices, motor vehicle parts and equipment, motor vehicle maintenance and repair, audio and video, sporting goods, and furniture.
Okay. All right. So, man, I listen to that and I say, what's the big, why isn't this transitory? I mean, I guess you can say the ironing out the supply chains sufficiently is going to take time. It's not, in the vehicle industry, it's all about getting chips from Asia so that the vehicle manufacturers here can produce more, get more on dealer lots and get those prices down. And that's a process. So that's not transitory. That's not next month. It may even be next quarter, mid next year. Certainly by this time next year, you would think that would be ironed out, unless something really goes off the rails with the pandemic.
Correct.
So in my mind, I guess we'll get into semantics about what's transitory, not transitory. But if you define transitory as not that it's not should not affect the conduct of monetary policy, then would you consider this, what we're observing now, as transitory or non-transitory or more persistent? Maybe that's kind of a dumb question, I guess.
No, I think it's good. I'll let Chris go first.
All right. Is this, in your mind, transitory or not, Chris, what we're observing? In my mind, this feels like transitory, right? It doesn't feel like this is a persistent problem with inflation. Yeah, it's going to last a little bit longer, but that's because of the disruptions that occurred. It's not something, inherently, fundamentally lifting the underlying rate of inflation
Correct.
here on a consistent basis. Like rent growth. Rent growth, that's a different
coming.
story.
That's
coming.
where I was going to go.
Right? That's already here.
No, not really. I mean,
it's not all there.
No, it's not all there. It's really coming.
Yeah, that's
you're saying
that's where I was going to go. I think the part that Ryan has identified is transitory, and a couple quarters it'll subside, but I see that rent tsunami coming. It's not in the number. It's not baked in the numbers fully. So I think that is going to persist for quite a while.
Okay,
but when that comes,
yeah,
we're going to have a massive disinflationary force from supply chains.
Yeah, agreed.
So,
yeah. Okay. So you have some offsetting.
Yeah, you have a lot of offset there. Yep. So things are going to settle back
But-
down to the Fed's target.
Yeah. Well,
By the end of next year, that's what you're.
that's what I'm saying.
Yeah,
That's
I
what
would
you're
say.
saying?
Yep.
In fact, I think the risks are pretty symmetric here. I mean, you could construct a scenario where rents accelerate more and the disinflation for these supply disrupted vehicles, audio equipment, don't fall quite as much. But you can also construct a scenario where the risks are that you get lower inflation, right?
Mhm.
That the disinflation, deflate, and it's not even disinflation, it's outright deflation. I mean, vehicle prices are like stratospheric. They're going to come crashing back down. How do you like that for a metaphor, crashing back?
That was impressive.
Is that a metaphor?
Yeah.
That's not a metaphor. I don't know, but you get.
That's a Zandyism.
That's a Zandyism.
Zandyism.
Yeah.
That's
Yeah.
got to.
But you're right. If you kind of extract what trend growth is in new vehicle prices, used vehicle prices pre-pandemic, and just extend that forward and look at where we are now, we are, miles, higher. So those prices are mean reverting. Maybe we don't go all the way back, but even if we retrace half of it, that's a lot of disinflation.
Deflation.
I don't like
Oh, you
using
mean-
the word deflation.
Oh, you mean disinflation in the aggregate sense?
Yeah,
Deflation
yeah.
in the sense that those
Specific.
prices.
Oh,
are
yeah,
going
yes,
fine.
you're right.
Yeah. Right. Okay. On the rent side, you didn't explain, Chris, and you took it for granted, I guess, but for the listener,
Yeah.
what's the deal on rents? Why are they rising so quickly?
Largely has to do with measurement and how the BLS accounts for changes in rents over time. So prices, as we know, house prices have been rising, but the asset values don't go into the CPI themselves. It's some type of user cost of those properties. So the BLS measures either the rent that people are paying, right? If you're renting a property, what is the change in that rent over time? So there's one category for that. That went up 3% on a year-over-year basis. They also try to impute something called the owner's equivalent rent, which is how much would you have to pay if you are a homeowner, how much do you estimate you would have to pay to live in your home? What would the equivalent rent be to live there? That went up a little bit faster, 3.5%, perhaps because homeowners are accounting for the fact that home prices have risen. That might be working into their calculus. So assumption is that these changes, right? Rents tend to be sticky, right? So those contracts don't get renewed every month. It may take 6 months or a year to actually catch up with the changing house price environment. So for that reason, we may continue to see additional rent increases feed into the CPI over the next year or so.
Yeah, that's all good information. Actually, I was asking a slightly
Oh.
different question. Yeah, but,
What's that?
but
Sorry,
I let you
sorry.
go because that's
All right.
good too. Yeah.
All right. Fine.
Yeah,
fine.
yeah, not really answering my question, but that's okay. That was still very good information.
What's the question?
Why are rents rising so fast? Well, fundamentally, what's going on out there that's causing
Oh,
rents to rise
it's a
Yeah.
supply demand issue, right? There's
Yeah.
a lot more demand than supply, just like everything else. So
And why isn't that going to
Right.
get solved anytime in the near future?
because it's very difficult to build homes. There are supply issues there. Price of lumber is okay.
Back over 1,000.
Yeah, well, there was my statistic, but
Oh, well, there.
yeah, I gave it away.
No,
I couldn't keep it in the bag. It's back over
You guys haven't
1,000.
gotten mine yet, so
All right.
good.
Yep.
I'm
All
still
right.
good.
I got others though. Don't worry.
Mhm.
Okay.
Got
All
some
right.
back. So yeah, I think the costs are continuing to rise. when it comes to new homes, and supply of existing homes remains very low. People are kind of sitting on their properties, not willing to sell at this point.
Yeah. So for a lot of this energy supply disrupted products, those prices are gonna come in quickly. Energy's already coming in. The supply chains are gonna iron themselves out, and those vehicle prices and other supply disrupted products are gonna see prices fall. But the one place where we're gonna see continued strong inflation, and you're arguing an acceleration in inflation here over the next year or two, is on rents, and that goes to this very severe shortage of homes, rental property, and actually the shortage is even greater in the market for home ownership. If you look at the vacancy rate for homes for sale, that's at a all-time record low. So, and of course, a lot more people are renting single-family homes as opposed to renting apartments. So that's going to be more persistent. The way I characterize that, though, is that's the way the Fed gets from pushing inflation below their target, which is where we were pre-pandemic for really all the expansion since the financial crisis to the pandemic, to its target, which is now higher, right? They raised their target because we were so low for so long. They want inflation to be a little bit higher for a longer period of time. And the way you get there, the arithmetic, is higher rent growth. That's kind of where it's going to come from, right? That's kind of how I viewed it.
That's certainly part of it. You don't ascribe anything to persistent wage inflation. Do you think this all gets ironed out?
This is interesting. Yeah, I don't understand this completely, because wage growth is up, no doubt, but all of that wage growth acceleration has been in the low part of the wage distribution. These are, and I know this from the Atlanta Fed wage tracker. Atlanta Fed tracks the same individuals over time, so it's the best wage data because it's not messed up by compositional issues, industries and occupations, that kind of thing. And it shows that all of the wage acceleration that we've observed, at least so far, has been in the bottom quartile of the wage distribution. And that's lesser skilled, younger people, the folks that work in industries that got nailed by the pandemic, leisure, hospitality, retail, restaurants, bars, personal services, that kind of thing. And those are the places where people are most worried about, they're more likely to get sick, right? Because they're interfacing with people more than anybody else. They're not like you and I sitting in our back deck, or, I'm in my bedroom right now, and, I talked to one person outside. I went to get Wawa coffee this morning. That's the only contact I had, right? And probably the only contact I will have today with somebody. No, I'm getting my booster shot. I'm going to get my booster shot later this afternoon. So I'll have two interactions. And also, these are the folks that more reasonably are fearful of getting sick, right? And they're younger, and they probably many of them have kids, and getting childcare is already. So I guess my point is, that's where the labor shortage has been most severe, again, as a result of the pandemic. And that as the pandemic recedes and these folks start coming back in, and by the way, you could see that happening in November, labor force participation for people with a high school degree surged in the month. Now, maybe it overstates the case. It's, volatile monthly data, but nonetheless. And so I would argue that wage growth is going to decelerate. And then the other thing I'd say is productivity growth is up, and it's not only about the wage growth. When you think about inflation, it's not only
up, Chris, it's up.
Oh, it's up. Come on.
Oh, I mean, you can try to hang your hat on one quarter. So we actually did have.
So no, I'm the optimist. I'm still the optimist.
You're the optimist.
I'm the optimist. But that last data point is.
So we did have some listener feedback, and they did want us to talk about productivity. So Mark, perfect segue.
Okay. To do it. Go ahead.
So there was a big drop in the third quarter and a big upward revision to unit labor costs. And what I told the listener, I was like, you don't
unit labor cost. Define what that means. Yeah, unit labor cost.
It's cost per unit of labor.
Well, it's labor.
It's a proxy. Yeah, it's labor.
Yeah,
it's a proxy for wages,
output.
Compensation, things like that.
You see, I said it's not self-evident.
No, I thought you were quizzing me
again. It's not self-evident what that is.
All right,
there you go.
So that data is really volatile. Even quarter to quarter, even year to year, it's subject to big revisions. And one reason we didn't talk about it a lot is that you got to look more at the trend in productivity growth and unit labor costs.
Yeah. So
yeah.
And the trend is up.
But
in this quarter, productivity is going to be way up, right?
Oh yeah.
I mean, because GDP is going to come surging back as Delta is wound down. I mean, I saw our tracking estimate for Q4 is now 8.7% annualized growth in GDP, right?
Correct.
So, and job growth is, if anything, it's kind of, it is what it is, 500,000 per month, which is strong, but no acceleration. So, if anything, we're going to get a bounce back up in Q4 productivity growth. And that's neither here nor there, really, when you're thinking about what it means for inflation. It's really about the longer running trend here.
Exactly.
And you can see productivity growth has definitively started to move higher. If you look over the last 5 years, for example, just to smooth out some of the quarterly volatility in the data to get to the underlying trend, it's definitively accelerating at this point. Pretty much almost back to the 2% that's prevailed since World War II, which is quite surprising, if you believe it. Yeah. Okay. All right. Okay. Anything else on the CPI number that we should call out? I know you dig real deep into the bowels of these reports. Anything you may want to save that for the game, which we're going to go to next.
Yeah, we can save it. I got to come up with another number.
Okay. I'm going to go first because mine is very apropos.
Oh boy.
And it's another. Oh, I'm not going to give you this hint because it might give it away. But it's 2 numbers. You ready?
University of Michigan.
Is that it?
Inflation expectation? No.
No, I mean,
No.
I don't go back to that well very often. You see how he does this? He's guilty of this, and now he's like making me feel guilty. I don't do this. Oh,
there's nothing wrong with it. There's nothing wrong with it. There's
Chris's second number is something housing related.
Yeah. Chris,
I already gave you the second.
Okay.
I already gave the lumber.
Here's 2 numbers.
All right.
And actually, I better check these numbers before. Okay. Yeah, because there's so many numbers in these reports. Okay, ready?
Yeah.
You got to tell me what these 2 numbers represent. 5% and 3.3%. And this is very important to the outlook for inflation as well.
Jolts.
Year from now.
Jolts.
It's not. This is
Not
not Jolts. Jolts is job opening labor turnover survey, that came out this week too. That was pretty interesting.
Yeah.
Let's not go down that path.
No.
We can go down that path. Although there were 11 million close to a record number of open job positions. So.
The difference between the number of job openings and the number of unemployed is at a record high.
I saw that. Yeah, I'm a little surprised that wasn't your number. Your for the game here we're playing. And by the way, everyone knows this game, right? We each give a statistic, and the other guy's got to guess it. And as you can see, these guys are stalling because they have no idea.
No. Are you going down the median CPI and trimmed? No, the trimmed PCE.
No, but I could have done that.
You could have. Is it the change in the CPI over the last 2 years?
Oh, you got it. Core CPI. Core
CPI. Okay.
Okay. All right. Let me explain. But you got it. You deserve credit for this. So 5% is the year-over-year growth in core consumer price inflation. Core being excluding food and energy. By the way, for folks out there, they go, well, why do you keep stripping stuff out? Why are we doing that? And the reason is because there's been a lot of research that shows that the core CPI is the best predictor of near-term inflation. So out 6-12 months from now, because the energy prices that we've been discussing and food prices, go up and down and all around in a given month. So you don't get any information about where we're headed if you look at overall CPI. But if you want to forecast the future for inflation, the best measure to start with is the core CPI because it gets rid of that volatility in energy and food. And that was up 5% year over year through November, which, that's high. That's double where you'd want it to be. Again, the target here is 2.5%, so you're double. And the 3.3%, the second number I gave, is the annualized growth in core CPI over the past 2 years through November. And this highlights a very important point, and that is another reason why inflation is so high today is what economists call base effects. That is, inflation was really, really low last year at this time because of the negative consequences of the pandemic. This was before the vaccines. Businesses weren't shut down in the same way as they were earlier in the year, but the economy was still struggling. You remember back, we were talking about possibility of going back into recession in December of last year. In fact, the economy lost jobs in December of last year because it was really struggling. It hadn't gotten any additional fiscal support from Congress and the Trump administration, so it was really struggling. But if you look over the past 2 years, you abstract from those base effects, right? So November of 2021 versus November of 2019, I look at the annualized growth. That says, well, that abstracting from the weak inflation of a year ago, those base effects, it's 3.3. 3.3 is high. It's higher than 2.5. Again, that's your target,
but not that high.
Not that high.
Yeah.
And by the way, this is the other point why inflation could be really low a year from now, because the base effects are going to go in the other direction, right? Because I'm now at 6.8 on core. I'm at 5%, right? 5% year over year through November. So that's going to make it much easier that inflation, and here I'm going to go so far to say, I talked about the risks of inflation. I think there's a reasonable probability inflation is actually going to be, close to zero. Top line inflation going to be close to zero because of the next year this time, because of these base effects and all the things we just talked about. All right, now that.
So
listener, this is a good. What I gave was a good statistic. Why? Because it wasn't too hard. Right? Ryan eventually got it. It took him a little while, but he eventually got it. It wasn't too easy. It'd too easy. If Cris got it, then that would have been too easy.
Yeah. Like Chris's lumber price number would have been.
And it's relevant to the conversation. That is a beautiful statistic. Would you agree or disagree?
Yeah, I would agree with you.
Absolutely.
That was good.
Absolutely. That's a good one. That's a very good one.
A little self-promotion.
Okay,
right. Pat on the back.
By the way, at Mark Zandy. I'm just
there
saying.
We go.
At Mark Zandy.
You got to tweet that one out.
Okay, I'm feeling too giddy. It feels like it's already 9
o'clock
at night.
Yeah.
Anyway, okay, who wants to go next? Oh, though, Ryan, you had something you wanted to say. I interrupted you. I wouldn't let you.
No. I was going to say.
No. Okay. All right.
No, I just agree with you on. I was going to say, are you coming closer to my inflation forecast?
No, that's a point forecast. That isn't,
all right.
I don't know.
You'll get there. I don't know. You're starting to drift.
He's inching. He's inching.
Yeah.
All right. Who wants to go
Cris.
next? In the
Cris go.
Okay,
sure.
Good.
3%.
Oh.
On the nose?
On the nose. 3.0.
3.0. Is this related to the CPI number?
Nope.
Jolts?
Oh.
Nope.
It's not Jolts. It's not CPI. UMISH came out today. No, that was.
Is that 1 year inflation expectations?
Oh, you're so close. 3%.
12-year or 12-month.
Nope.
No, long-term inflation. It's got to be one of these
5 year.
Right.
5 year.
I would have gotten there eventually.
Is that ours? Is that ours?
No, it's the UMISH. That's the UMISH.
Oh, UMISH. University of Michigan survey did come out, and it's 3% over the next
3% over the next 5 years, unchanged.
Oh, okay.
Pretty much unchanged all year. I mean, it's bounced around a little bit, but
that's interesting.
I point to that just because of the expectations aspect that we've talked about in the past being so important. We got a little volatility. We got a lot of volatility here now, but in terms of those longer term projections, I do agree with you that we're not going in this hyperinflationary environment. So
yeah, that's a good one.
Consumers seem to agree.
Yeah, that's interesting. If you thought anyone would be a little spooked by the inflation that would reflect in their inflation expectations, it would be consumers, but you don't see it in the University of Michigan survey.
Even the 1 year is it's 4.9%, but that's unchanged as well. So
is that right?
Yeah.
Well, the other inflation expectations measures all look pretty good. I mean, the ones that I tend to follow more are those that come out of the bond market. 5-year forwards. The break-even inflation from Treasury inflation protected securities. They all look pretty good, right, Ryan? They don't.
Yeah, they do.
They don't show any real.
Yeah, they don't show any sign of getting dislodged, where the Fed would have to panic. And we talked about this in the past. The Fed can be patient as long as inflation expectations remain anchored, and all signs are that they are.
And of course, economists' expectations, is measured by the Philly Fed survey, which we participate in. That's right on. It's moved up. But it's moved up largely because the way the question is asked, and I know this because I answer the question, is, what's your average annual inflation rate over the next 5 to 10 years? And just simply doing the arithmetic, inflation is high right now, that you're going to get a high number, you're going to provide a higher number than you otherwise would, right? If you ask me what is inflation a year from now or 2 years from now, it'd be right back down to, where, low, 2.25%, 2.5%. So economists' inflation expectations are right on target as well. So no sign that inflation expectations are coming untethered here, at least.
Right.
Yeah. Okay.
So I had
a good one.
I got a couple client questions asking me now. I want to pick your brains, see if I went, too confident with this one. What's the probability of hyperinflation in the U.S.? What percent would you put on it?
Hyper.
Basically, to think about the doubling of prices every year. That's hyperinflation.
You mean like Germany circa
Venezuela.
1920?
Venezuela. Yeah, so I had a couple client questions. Like, what
Oh.
would you put the probability of that happening in the U.S.? I said 0.
0. Yeah.
All right. I didn't.
The Fed's gonna
How
clamp
would that
down.
happen exactly? Under what?
Usually, it happen when you have like a loss of confidence in the currency, and the central bank's just printing money left and right. But that's not
the
gonna
only
happen.
way, right?
That's
I
I can't think of any other way.
But I'm asking in the current context in which we live in the United States of America in December 10th, 2021. What's the scenario?
I couldn't come up with one. That's why I said 0%.
Oh yeah, I agree with you.
Okay.
I'd say yeah, 0.
Usually as economists, we want to say there's absolutely no probability of something happening, but this one I'm pretty confident would not happen.
Well, okay, I'll take that back. Let's say a meteor lands in the middle of the Central Valley of California. I could envision hyperinflation in that scenario.
In wine prices.
A small meteor, or what's the dimension of this?
That would be a pretty sizable supply side disruption, I'd say.
All right, so 0.1%.
Okay, there you go.
All right.
Of course, we have technology to push meteors off track to hit us. Did you see that?
They're testing it. Yeah.
Yeah, they're testing it. Yeah. All right. Okay. That was a good one though, Chris. All right, Ryan, have you
I came up with a new one.
Here? You came up with a new one? Okay, fire
All
away.
Right. 219,000.
It's not initial and unemployment insurance claims because that came in unbelievable. 188,000 in
lowest
the week.
Since the 1960s.
Actually, I'm a little nervous that it's too low now.
Well, yeah, that's going to be revised.
Yeah, I don't know.
But I mean,
saying that for a few weeks now, it's going to be revised.
Week to week. You have to ignore jobless claims. But it was all seasonal factors. So the seasonal factor anticipated roughly 100,000 increase in new filings. We got a 60,000 increase. So the seasonal adjustment factor just crushed the number that was reported.
So what's reality? Where are we?
That's why he went.
That's my number.
That's why he went with the 4-week moving average.
There you go, Chris.
4-week moving average. Wait a second. Then don't I get credit for this somehow? I mean, I'm the one who called attention to the UI claims.
Yeah,
I was getting there. No,
Chris jumped in.
Oh, I didn't hear him.
No, you can get partial credit.
All right,
so
we can share.
Some credit.
We'll share.
I mean,
I'll share.
You'll share.
All right.
And I mean, I did it so gracefully too. I didn't even take credit. I just started talking about it. All right.
Yeah, you get your.
But you asked for credit afterwards,
which wasn't very graceful.
No.
Yeah, that's a good point. Actually, I should have just let it lie. Let it sink in. Everyone would realize.
Oh, that's Andy guy. He's.
It's Andy
but now,
right? Yeah, now, oh my gosh, what an ego! You got to get credit for everything. There's truth to that, though. Yeah. All right.
219.
219 is the 4-week moving average, and that's reality.
No,
that's closer to reality. Well,
it's closer to reality.
Yeah.
Okay, what's reality?
184
Where do you think we are? Where are we on UI claims? Initial claims from unemployment insurance. This is layoffs.
230, 225, 230.
That's
low.
Employment. That's
low.
Employment
Yeah, yeah, for sure.
Yeah. You don't think we're at full employment though?
No. Prime age.
Yeah, right. Prime age EPOP. Employment to population. Okay.
But it's encouraging. I mean, it's not surprising that we're getting very low levels of claims because businesses aren't laying off workers. People are quitting left and right, but layoffs are very, very low.
Yeah. Hey, it's almost like we could call the podcast right here. It was a pretty darn good podcast, but we should move on, don't you think?
No.
You thought I was serious. We could, but no, we should keep going, I think.
No, our listeners have become accustomed to,
I know.
1-2 hour.
Yeah. Well, we've already been
dialogues.
talking for 45 minutes or something.
Yeah. Have we?
Yeah, I think so.
Oh, wow.
Really? Wow.
Time flies.
All right. Well, we'll that's okay. We're going to push forward. So the topic that we're going to tackle, as you know, we do the statistics check and then the game check and then the big topic. And the big topic is the deep dive. And this week, I thought we'd dive into bubbles, asset markets. And it just feels like a lot of pieces of information data out there that signaling that that asset markets. When I say an asset market, it's stocks, that's bonds, that's housing, that's crypto, if you can call that an asset, which we can debate, but some people view it as an asset.
Chris would.
Yeah, Chris would, obviously. Commercial real estate, commodities to some degree, anything that people attach a value to and is a store of, quote unquote, store of value, that's an asset. And asset prices, the price for, you pick it, pretty much everything, has gone like completely skyward here. And the question is on the table, is it a bubble? And first, to answer that question, is it a bubble? And of course, if it's a bubble, that's not a good thing because bubbles often burst, and that means prices fall and people lose money, and that has economic implications. The housing bubble burst, and that created the financial crisis. And of course, we had the Y2K bubble. That was the internet bubble in the equity market back in the late 90s, early 2000s. That blew. That did less damage because that was equity, not debt, which we can talk about the distinction there. But nonetheless, bubbles generally end badly. So it's an important question.
They have to end, right? If it
By
doesn't
definition,
burst,
right.
It's not a bubble, right?
No, is that right? Is that true?
Well,
can't they?
I guess you can deflate.
I have this metaphor of a bubble, and I can take the air out, can I? And doesn't necessarily.
Can you think of an
burst.
example where that happened, where we deflated a bubble without it popping? I can't.
Well, there's only. I can only think of two historical examples of bubbles. One is the housing bubble, and the other is the Y2K bubble. Are there any other? I'm thinking about it in the U.S. context. I'm sure there's cases overseas that I'm not thinking about. So
when oil prices skyrocket and then they come down, do you consider that a deflation? Is that a bubble that deflates, or how would you characterize that? Right.
That's a good
I
question.
remember a few days or
Yeah.
years ago, we had this huge run up in prices, and then the
Oil-
economy didn't actually collapse or anything.
Yeah, that's a good
But-
point. Oil is an asset, right? And it goes up and down in price, and it can be subject to speculation because it's price is determined in a market, a financial market. So yeah, I think you would consider that. So yeah, that rose and then burst. Well, that's deflated. That might be your example.
That's my
your
example. So-
Yeah,
but then-
is that what you're
then-
saying?
then I don't
Yeah.
consider that a bubble. Then it's just
Right.
Oh, you don't.
it's
Well,
Like, would you say
okay,
used car-
for me, a
define
bubble
then.
has
Yeah,
to
you
cause damage, right? There.
Yeah,
Right.
No, I don't know.
Well, that's my definition, right? So
Really?
let's
Okay.
agree on the definition here.
All right. What? How would you define it? I'll hold mine in reserve. But how would you define a bubble?
I would
In an
define
asset market.
a bubble. I would define as a situation where prices are outstripping fundamental values, and they are followed by a significant or sharp correction back towards that level. They may overshoot or they may land close to the fundamental value, but it's
Okay,
not
I have a higher bar.
not a gradual return to equilibrium. It's a
I would
significant-
include speculation. I think
Yeah.
speculation has to be part of a bubble.
Exactly.
Yeah. Well, I guess that's what I mean by outstripping fundamental value.
No, you can have I'd say markets right now are outstripping fundamentals, but I'm not sure they're a bubble, right?
You don't think they're speculative?
Oh, I'm getting closer
Not
to
to
saying
the
they're a
point where,
bubble.
well, that's why we're talking about it because
Okay.
we're moving in that direction.
I guess it depends which asset we're talking about.
Yeah, it depends on which asset we're talking about. But you would say then a bubble is a asset that is overvalued. Its price is outstripped its underlying source of value. Corporate earnings, stocks, rents, housing, crypto. Who the hell knows? That's why it might be a bubble. That kind of thing.
Yeah.
Right. Second criteria is that there's speculation. Okay, define speculation. What does that mean?
Oh, I would describe it as just people buying something because the price is going up.
Yeah. So I'm going to buy
They're just
today,
chasing. Yeah.
because I think I can flip it. That would
That's
be
a
the
good point.
terminology in the housing market. I can flip it and make a quick buck, right? That's the only reason I'm buying this. It has nothing other than I'm going to find the greater fool, the bigger fool than me, and I'm gonna get out. And I'm smart enough to get out of this quicker than anybody else before it goes down. Yeah. Okay. So you need overvaluation. You need speculation. What else would define a bubble? Anything else define a bubble?
There's always the question about leverage.
Yeah, good.
That's a good one.
Is
Yeah.
that
Does it have to have leverage though?
I don't think it has to, but I don't think it's a necessary condition, but certainly it's supportive.
So the idea there, leverage, you mean the buyer of the asset borrows money to buy the asset.
Correct.
Mhm.
And if
Fueling that
happens,
speculation.
and that bubble blows and the price falls, of course, the amount of debt owed doesn't decline. It's still the same amount of debt.
Right.
That's the prescription for the borrower, the buyer of that asset not paying back that debt. And then you got a financial crisis, right? Then you got a financial problem because all those creditors, all those banks and everyone, finance companies, whoever extended the credit, now got a problem. And then that reverberates around that hurts everybody, right? Because everyone is going to be affected by that because even good people, good credits can't get credit to do whatever they want to do. Okay, so it's overvaluation, it's speculation. Leverage definitely is a tell, but it's not a necessary condition for a bubble, is what we're saying, right? But
I would agree.
It's generally an element of a bubble, generally.
Right.
Okay.
And then there's I guess
it has to blow. It has to.
Yeah,
go.
the correction, is that necessary, or I guess that's where we differ in the definition. I'm saying it does.
Yeah, because there's a bubble can burst and prices, meaning go crashing down, or the bubble can deflate, meaning prices go flat, right, and stay where they are and let the underlying source of value,
catch up,
earnings or rents catch up, right?
Mm-hmm.
Okay, I would say my sense is that's the possibility. Bubbles can burst and they do burst, and we've seen that, but that isn't a necessary condition. Because you only know, then you're saying I only know a bubble ex post. I have to see it burst before I know it's a bubble.
But that's partially true.
I don't believe that to be the case.
That's partially true, though.
Well,
it's really difficult to identify bubbles in real time.
I'm pretty good at it, actually. I'm pretty good at it. Yeah.
I think the challenge is the fundamental value. What is value, right? That's always been the challenge. Right?
Yeah.
Okay. Actually, our models, by the way, help us with this, right?
Yeah, correct.
They really help us with
this
because the way you want to describe how we model, Cris or Ryan, how we model asset prices? I mean, it's actually, I think it's a pretty cool way of modeling things, I think. I don't know I don't think it's that novel, but it's very interesting. And I think it's a useful way of, by the way, I don't think as economists, you can talk about the economy and the prospects for the economy without talking about asset prices, particularly when asset prices are significantly high relative to their underlying source of value, or very, very low relative to their source of value. Generally we don't talk about stock prices or bond prices or housing values unless that's the case, unless values are very high or very low, and then that becomes that's a macroeconomic issue. That's an issue for policymakers. I mean, asset prices are in the reaction function of the Fed explicitly. The Fed is saying, hey, this is part of what I look at when I make a decision around interest rates. So this you can't put your head in the sand here. You got to have a view, and you have to forecast these asset prices.
Well, for the Fed, it's financial stability. They're not necessarily saying, oh, we want the S&P 500 to be X. They're not aiming for a certain level of the S&P. They just want financial stability, and that's why they're concerned. And they put out that financial stability report, I think twice a year, that they're seeing signs of froth in a number of asset markets.
Well, that's interesting. So, I mean, if you said to me, we had a bubble, overvaluation, speculation, but no leverage, therefore, if that bubble bursts, it's not a financial system problem, they would not be worried about it.
Correct.
They would not be considering that.
Right. There's got to be some sort of contagion component to it.
Yeah. Well, I guess that's reasonable. But again, we think leverage is if it's not a necessary condition, it's pretty close, for a bubble.
I guess there could be indirect leverage, right? So,
oh yeah, for sure. Right?
So they could still certainly be concerned about a market blowing up if the counterparties then are, have leverage elsewhere, right? So,
or I'm using the asset to buy other stuff,
right?
And leverage that stuff up.
Exactly. That's my
that's
collateral.
Your point.
Yeah.
That's your point.
Yeah, yeah.
Yeah, no, it makes a
So
lot of sense. Okay, all right. So uh, we've had two in recent modern history, two bubbles, because that checks all the boxes, right? The equity market bubble, the Y2K bubble in 2000, and the housing bubble that led to the financial crisis. Uh, any differences in those bubbles? Things that are important in the context of identifying a bubble, or in terms of the implications if the bubble bursts for the economy and for the financial system?
I
What can we
think,
I,
learn from the
yeah.
Super
yeah,
Bubble?
speculation was in both of them.
Yep,
So
they're
you think of
bubbles.
Y2K, everyone was
Yep.
buying tech stocks, anything that had .com attached to it. I also know somebody that started a business with a .com in there around that time.
Oh, yes, that's me. Yeah, economy.com.
You're a little slow on the trigger there.
Yes,
I was
sorry,
like, that was
that's a long
underhand.
time ago. Yeah,
Yeah.
Under,
actually,
overhanded.
It's
yeah,
over.
I paid a lot for that URL. Well, we paid a lot for that URL, economy.com. Although I think we got a pretty good return out of it. I think
It's still around. You still have it.
We sold it to Moody's, and they paid.
Well, yeah.
They paid for it. So they paid a pretty price for it. So I think we did.
But I
Okay,
mean,
but you're right.
back then, you had, what was it, pets.com, and
Yeah, oh, yeah.
it was all these tech speculation.
Yeah.
People were buying anything that was tech related, created a
Right.
big asset bubble.
Well, what's the big difference? In my mind, this is a quiz. My mind, there's a big difference between the Y2K bubble and the housing market bubble, circa 2005, 2006, and at least in terms of its implications, for the economy.
Oh, well, in terms of, I see lots of different, but in terms of implications, is just I would say the scope, who holds stocks versus who owns a home,
That's a good
right?
one.
So
Yep.
that certainly,
Right.
you hit housing, you're hitting a lot of people versus a relatively small group of
Yeah, I think
stockholders.
home ownership is what, 2/3, right, roughly.
Right.
I mean, give or take.
Yeah, yeah.
And how stock ownership, broadly defined, is about 50% of the population, and that there's a big chunk of those that don't own much stock at all. It's really
Right.
top
Concentrated.
25%, and that's the other big difference. You're talking about very wealthy individuals compared to middle income Americans.
And when you say contagion
Go
was
ahead.
a lot different. I mean, when the
Yeah.
tech bubble burst, that was isolated to people that own stocks. When the housing bubble burst, banks were holding these worthless assets, and that just caused the financial crisis.
Well, the way I would frame that, or to say that, is the big difference between the two is, one was the bursting of the equity bubble. I mean, it's equity, it's not debt, right?
Right.
There was some debt, margin debt, presumably, because people can borrow to buy stocks, but that was relatively limited, small amount of margin debt.
And that was an accelerator then, right? As we talked
housing,
about, right?
that was leverage. That was, people borrowed a boatload of money, 2 years exploding subprime arms, and also there was a lot of fraud, as we know.
Yeah,
certainly in hindsight, in those mortgages. People were lying. They weren't investor. They were investors. They weren't owners. They lied about their income. They lied about
the appraisals.
Appraisals,
biased. Yeah.
So very, very different. So the fallout from the bursting of the Y2K bubble was, we had a recession, but I'd say this: we wouldn't have had a recession after the Y2K bubble if not for 9/11.
Right.
9/11 is what did us in, ultimately, and that's how we got the recession. It would have been a tough, period after the Y2K bubble burst, but I don't think we'd had a recession. Of course, after the bursting of the housing bubble, that was a mess. And we had we were paying the price 10 years later until the pandemic. Okay, I view that as a big difference. Okay, let's go back. I asked the question. I don't think we answered it. How do we model asset prices? You want to describe that?
Sure. So we use an error correction framework, which is very intuitive in the sense it follows that process you just described in terms of assessing what is the fundamental value of an asset. So first, in the first stage of an error correction model, we consider what are the fundamental drivers of an asset. So if we're talking about housing, we might look at different supply and demand factors, population, or other factors that might influence how much housing really need to support a particular economy. So that we establish what the fundamental value is. We then project what that how those values might change over time. So we might look at different ratios, like a price to rent ratio or price to income ratio. We might assume that in the equilibrium, house prices should grow at the rate of income growth to maintain an equilibrium type of relationship. And then we, as a second stage, we model the difference between where the prices are at any given point in time and this fundamental value, and how quickly and by which process should prices change to converge to that longer run equilibrium. So it's those two stages, in which I think is a really nice mental device, if you will, because first you think about what is the value, what should the value of this asset be? And then as a second stage is, okay, how do I get there? And the speed at which you get there can vary depending on the asset. So if we're talking about stocks, for example, you might assume prices can adjust really quickly, right? They're fairly liquid, established markets. With housing, you have a lot of transaction costs, may take a longer time to actually adjust to those longer term values.
Yeah,
So
that's a good description.
in a nutshell.
Yeah. It does beg the question, though. You can't have a bursting of the bubble in our models. That doesn't happen. The model isn't going to say an asset market that's overvalued and speculative is going to burst, right? I mean, it'll basically say you're going to have prices come back down in a reasonably orderly way to where they should be, given the underlying thing that drives the value of that asset, right?
Yes and no. You couldn't have swings, right?
Mhm.
The model certainly can generate. You could have a fundamental value, and if you are well above that fundamental value, the model could have you swing around, right? Could induce a cycle.
The model's really, and I
Right.
don't mean this as any kind of criticism, because we built the models. It's pretty hard to design, to estimate a model that's going to give you that kind of correction, the error correction process, getting back down to the equilibrium value, so to speak. Here's the other thing I'd say is, if you look at our forecasts, when we're in a market that's significantly overvalued and you look at our forecast, it always shows the price of that, let's say stocks, for example, or housing, basically going flat, maybe down a little bit over time to let earnings catch up or let rents catch up to that value. We don't, that forecast can actually look silly for periods of time, right? Because by definition, a bubble keeps going. It's not a bubble unless it keeps going, and it gets bigger and bigger and bigger, and it finally sucks everybody in and says, and once everyone's in, then it blows. So you could look stupid along the way, right? Because you keep saying, oh, this market's overvalued, it's going to correct, price is going to go flat, come down, but no, it keeps going. But you even become more convinced that the market's going to go down, right? Am I making any sense at all?
So a difficult to model the discontinuity, the sudden jump, right? At what point do we decide, to correct, right? Why was it that particular Black Friday and not the Monday before?
Well, and you look at our stock price forecast. I mean, it's been, whatever value it is when we do the forecast, that's the peak. Because the model says that, it's overvalued.
That's right.
But of course, then it goes up the next quarter, and then we have the same thing happens. So someone looking at the forecast goes, "Are you guys idiots? What the hell are you doing?" But that's the reality of a bubble. You have to have the courage of your convictions. And you're saying actually, I'm even more confident that this thing's going down than I was a quarter ago.
Right.
And it's not. It's just you're the dumb one for buying into it. This is what happened in the housing bubble, right? I mean, for 2-3 years leading up to the housing bubble, we were saying housing's overvalued, we got a problem. Housing's overvalued, we got a problem. Prices kept going up, and then people say, "Well, what are you guys thinking? What are you guys doing?" And it affects, it has impacts. That's a bubble. That's when everyone is sucked in. That's by definition a bubble. Fortunately, we didn't get sucked into that housing bubble. We stood our ground. Same with the Y2K bubble, by the way. Go back and take a look.
So maybe another criterion is the justifications, right? Once the justifications get out of whack. I remember during the housing bubble, right? It was nesting, and people don't want to travel anymore because of 9/11. Therefore, they're going to invest in their home, right? So that you can start to come up with all kinds of ideas to justify why values can hold at this level. So
Yeah.
maybe
Or
that's
the
a
other,
corollary.
the other anecdotal thing is the infamous one. I get into a taxi cab, and the taxi cab driver saying, "Oh, I was just buying pets.com," or I just bought my 5th house on Long Island,
Yeah.
or whatever it is. So I'm
Yeah.
going, and that's the kind of crypto. Well, that gets us to brass tacks here. So the listeners now saying, "Enough already. Are these markets bubbles? What's going on?" So let's take them one at a time. Which one do you want to start with? And let's do stocks, because we could do this forever. Let's do stocks. Let's do single family housing, obviously, and let's do crypto. Anything else we should be doing? Do you think? Should I throw in, is that enough?
I think that's
Again, all the asset markets are pretty highly valued here. Prices are
No
high.
bonds to throw in
You want
Ryan's
through
10
credit
year.
spreads in the bond market, or the 10-year. You want to talk about interest rates in general? By the
We'll
way,
talk credit
people get a little
spreads.
confused here, but low rates means high prices, right? High bond prices. So
Yeah.
the lower the rates are, the higher the bond prices. And by the way, that's also another way of thinking about overvaluation, which I think we'll get to in just a second. So you want to talk about bonds as well? That's
Then we got the
we
whole
can talk about
personal
that all the time.
finance.
10-year treasury yield. We go back into that debate. Let's leave that
Well,
alone.
I mean, the discussion around crypto should be really quick.
Because it
is a bubble, but
It's clearly a bubble.
Yeah. So there you go.
Well, Cris is going to take the other side of that.
No.
So. All right. Okay,
Maybe the Zandy coin is in a bubble.
Okay. All right. Okay. We're going to do stocks. We're going to do housing, and we're going to then do crypto.
Okay.
Because we got to do crypto. When I say
Right.
crypto, that's now becoming a catch-all for all kinds of wacko stuff.
NFTs,
non-fungible tokens, and
okay.
stable coin, and so forth and so on.
It's just a matter of time until Mark has a NFT.
I know.
You're on
actually,
Twitter.
my
You're
son
gonna be on
already has an
TikTok
NFT.
soon.
He created an NFT with something. I can't remember what it was. I don't know if they sold it or not, but he was telling me about it. Anyway, okay, stocks. Okay, S&P 500. I'm looking at it today. I'm going to pull it up here just to see where it is. I'm guessing the S&P 500 is around 4,700. It's 4,696. There you go. And I think that's within spitting. Yeah, it's like that's a record high. That's pretty close to a record high.
Yeah.
I mean, we're pretty close. We're up, I don't know, 20% this year at least on the S&P, and that's after multiple years of whatever rise in price. Our model, going back to our model, says this market's overvalued by like 15%. Even at these low interest rates. By the way, that's an important point. Asset prices can be high, and they should be high when interest rates are low. And obviously, interest rates are very low, so asset prices should be very high. But what we're saying is here, they're higher than even you would think they would be given these low interest rates.
Correct.
So, okay, with that as backdrop, is the stock market a bubble?
Yes, it's overvalued.
Well, no.
It can be overvalued, but not a bubble.
Yeah, it can be overvalued. But remember, overvalued,
Yes.
check.
Yep.
Okay, overvalued, check. Well, I think we all agree on that.
Yes.
Meaning it's outstripped where it should be given where interest rates are, and the source of that value is corporate earnings at the end of the day. So,
Right.
And they're okay. They're pretty strong. So you would expect stock prices to be high, but it's overvalued. We're saying it's even higher than you would expect given rates and given corporate earnings, roughly speaking.
Use the Schiller PE.
I haven't looked at that recently.
Like, but in terms of overvaluation, that's my gauge, right?
Oh, the Schiller
It's not
PE?
it's not just the level, it's relative to earnings. So
okay,
Yeah,
so
that
there's a lot
says
of
it's
tried
overvalued.
and true measures of valuation. And you're saying, what is the Schiller PE? That's like a long run PE, right?
the cyclically adjusted price to earnings or earnings ratio, and I think it's just all the PEs are elevated. Certainly,
Yeah.
choose whatever you want.
You have
This
the
one
Buffett
is-
index.
What's that?
You have the
that's a good
Buffett
one.
indicator, which is the total value of stock or equities as a share of nominal GDP.
Yeah, that's the one I like. Yeah. Or I like even more than that. I like the value of all publicly traded stocks in the numerator, and the denominator corporate GDP. The BEA, Bureau of Economic Analysis, calculates GDP produced by corporate entities that are publicly traded.
That's a good one.
No, not publicly traded. All corporate entities, but the bulk of that is corporate or publicly traded company. And that is, if you look at it, got a nice chart of it. it's very, very close to the peak during the Y2K bubble. So, okay, overvaluation.
All of them. Yeah.
Check. We got that
Yep.
one. What about speculation?
So this is where I changed my view. I was like,
Okay.
it's overvalued, but not a bubble. It's a bubble.
Yeah. Why? What when you say what kind of speculation are you focused on?
Here, let me.
When you say that, I mean, in speculation, that's more of an anecdotal, generally kind of thing. So, what do
Yeah,
you,
so
what are you thinking?
I'm going to share a chart. Now, people listening, on the podcast won't see it, but on YouTube, you can see it. And
You can see it
Mark,
on YouTube.
I'm sure I can send it to you and you can tweet it out.
Okay, we'll do it. So you're going to pull up a chart.
Yep.
Okay.
So this is the value. I think we talked about last week, the value of margin accounts at brokers and dealers, and just look at what's happened recently.
Well, this gets to the leverage.
Leverage, yeah.
This is leverage, but also
Yeah.
when it's probably speculation.
Speculation, you're saying.
Yeah, I mean, you got to finance,
Right.
buying your meme stock somehow.
Yeah.
So meme
look
stock
how high
is
it
what
was
I
around
point to,
Y2K,
yeah.
right? That was consistent with the Y2K bubble, right?
Mm-hmm.
I mean, it's lower. I mean, back in 2000, obviously the economy was a lot smaller. So
Right.
we should probably deflate this with something, right?
Yeah, you can look at it probably as a share of GDP or
Yeah.
Or something
I can
like
come
that.
up with some, but
Yeah.
I mean, even so,
Still.
it's doubled in
All right,
a
explain
few
this
quarters.
to me. So you're saying it's gone from 300 billion. This is debt. This is what people borrow in their brokerage accounts to go out and buy stock.
Correct.
You're saying it's doubled since the pandemic hit.
Correct.
300
So
billion to 600 billion.
right. So this could be an accelerator to a correction. So a correction starts, you start to get more margin calls. If you don't have the cash to bring up your accounts, you're going to have to sell that asset. And then you start this cycle where, we get a bigger drop in stock prices because of these margin calls.
Is there any other benign explanation for this, Ryan? What else could be explaining this other than people are starting to lose their minds?
I go to that one, that people have lost their minds.
Really? Okay.
Mm-hmm.
Chris, do you know any other explanation for that surge in margin debt? No.
I'm not sure.
Oh, well,
can you
I'd
buy
like to know
crypto
who's
on
taking
margin?
on that margin debt. That would be
Right.
interesting. Well, I guess there's other signs of that's a really good one, Ryan. I guess there's other signs of speculation. I guess meme stocks, right?
Yeah.
GameStop, good example. Like they're just picking a stock and just buying it just to do it.
Yeah.
Drive hedge funds that have shorted it crazy. I mean, I guess that was GameStop.
Yeah. I guess options activity is another.
Oh, I haven't looked at that. Have you looked at that recently?
Just at a high level, I understand that options activity is through the roof. People are actually
really? Okay.
buying and selling more options than underlying stocks. So the speculation is.
I'd love to see that data. If I haven't seen that data, that would be interesting. Yeah.
You have something, Ryan?
Yeah,
we can track it down.
Yeah.
I can track it. Yeah, there is an indicator. I don't remember exactly. It's like you look at the share of puts versus calls, something like that, and it's like a a bearish signal or a bullish signal. So I can take a look at it.
I guess SPACs would also be kind of another sign of froth, at least.
Mm-hmm.
Those are special purpose acquisition companies, I think. So these are kind of shells of corporate entities that have been established to go out and, instead of IPOing, you can create a SPAC and put assets into it and create a company, I think. I guess that might be a sign of froth. Well, okay, so Ryan thinks this is a bubble.
Mm-hmm.
We've now reached the threshold for a bubble. Overvalued, speculative, and leverage.
Correct.
Chris, would you say it's a bubble?
It's a bubble now, but we have to wait for the correction, right? That's the.
Well, it's coming. The stock market corrects every, on average, every.
There's a high probability this is a bubble, if you want me to put it that way.
Okay, I'd say it's a baby bubble. That comes
Now we're going
rolls
back
off
to
the tongue.
Baby bubble.
Say that
baby
a few
bubble.
times.
Well, I
It
think we got
actually
the title
feels
of our
good to say
podcast.
it. That's the title of the podcast.
Yeah,
somehow,
baby bubble.
some way. Baby bubbles.
Yeah, we'll get it in there.
Right. It's a baby bubble because it feels like a bubble, but it's not quite big enough to really be a bad bubble. A big bad bubble. Oh,
Big
I
bad
love that. It's
baby
even
bubble.
better. Big bad.
Baby
Ben,
bubble.
are you?
Ben signed off. He's out.
Ben signed off. Big bad bubble. I'm gonna write about Jesus. Big bad bubble. this weekend. That's what I'm going to write about.
Oh, that's your COVID-19
It's like COVID-19
update.
Oh, did I tell you guys at Mark Zandy? Did I tell you that today? At Mark Zandy.
Yes.
I'm having way too much fun.
There's your viral tweet.
I'm having way too
something
much
in the
fun.
Wawa coffee this morning.
Yeah.
Oh, jeez. Oh, all right. Okay. Well, that's stocks. Okay. We concluded that if stock prices rise another 20% in the coming year, I think we got a problem. Especially if margin debt goes from 600 billion to 800 billion.
Yeah.
Got
or a trillion. Yeah.
So keep your eye on that one, baby. All right. Okay. Single family housing. All right. Chris, you got to lead the way on this one.
Mm-hmm.
What do you say?
Is it a bubble? I don't
Do the
think
checklist.
so. Okay. All right.
Do the
Overvaluation, yes.
Big time check, right?
Yes. Price to income, price to rent ratios. Take your pick. They're all.
Well, you did a really cool chart, though, Chris.
All up.
I don't know if you can pull it up, Ryan. The percent of metropolitan areas across the country, and there's 400 plus MSAs, metropolitan statistical areas, that have had house price growth of over 10% in the past year is 80% of them. 80% of the MSAs have experienced double-digit price growth, and 25% of them have experienced 20% plus year-over-year growth. Yeah. And of course, incomes rents haven't risen that fast.
Yeah, and it was 50% during the housing bubble.
Yeah. So by this,
right.
If you looked at that measure, you say this is even worse. What we're in now is even worse than the bubble we were in back in the mid 2000s, right?
That's right. All right. So overvaluation that
no
does
problem.
get the check.
Check.
Problem, I would say, no problem.
Although someone might argue, Chris, just to press you on that one a little bit. Remember the affordable housing shortage we talked about? So hey guys, there's no supply. Why do you think it's overvalued? And by the way, fixed mortgage rates are 3%. So why shouldn't house prices? And we've got remote work, meaning all these New Yorkers are moving into Atlanta and driving up prices, or Bay Area residents moving into Boise and driving up prices. So isn't that account for the high house price growth we're observing?
So I would say their prices right now are disconnected from fundamentals today, right? Price to income ratio is out of whack. Price to rent ratio is out of whack. But if you wanted to claim that in the future incomes are going to rise faster or rents are going to rise faster and restore that balance, sure, it's possible, but I don't see it. I don't see incomes screaming ahead to compensate.
Yeah. Okay.
So,
all right. Overvalued.
But
speculative.
At a national level, I don't see it. Some markets certainly look frothy, but on a national level, I don't see what we saw during the housing bubble.
Flippers, guys coming in, people coming in, buying, and then quickly selling for a quick buck.
You don't see that. Right? That's right.
Yeah.
HGTV.
You see investors, but they're longer term, right?
That's right. So you do see investors coming in. I think that's motivated by the lower interest rates, right? They're looking for yield, but they seem to be more of the buy and hold variety. I'm going to buy this property. I'm going to rent it out, income generating, right? I'm not looking to flip it right away. A lot of these investors are coming in with cash. I guess this goes to number 3, which is the leverage. Yeah. They're coming in with cash. So there too, they're not going to flee necessarily at the first sign of, a small decline in prices. So I don't see the investor leverage, and even on the homeowner side, we also see mortgage standards are pretty tight. So overall, leverage doesn't look that concerning, but it's starting to get concerning. Mortgage debt is growing at an accelerated pace now, about 9% year over year versus 5%.
Have you dug into that at all, that acceleration in the growth in mortgage debt outstanding, and what is driving that? Do you have any sense of that? And we get this nice data from Equifax, the bureau, so we can look at it by score band, we can look at it by region. We can look at it in lots of different ways. Have you noticed anything in particular in that data? Is it broad based? What's going on?
It's fairly broad based. So it's not that I don't see subprime. I don't see that we're doing a lot more lending in 620. But you do. If I look at the Fannie Mae, Freddie Mac reports, and they do show some loosening of the standards there. So again, it's not all the way back to those crazy levels, but you do see more folks with higher debt to income ratios, so a debt to income ratio above 43%. That is growing. The fraction of loans that are to people with less than a 680 credit score also growing. So there are some signs of concern. So I would say not a bubble right now, but if we keep at this for another year, then I'm concerned.
So I was going to ask. So house prices,
that's the red flag.
Yeah, house prices are up, I don't know, 15 to 20%, depending on which house price measure you look at over the past year through, let's say, October. What I'm hearing you say is the housing market is overvalued, but it's not a bubble yet. If house prices rise another, say, 15 to 20% between now and this time next year, you'll probably be saying this is a bubble. Yeah.
What about some irrational behavior? People buying houses and dropping the appraisal or home inspections. That's
an interesting point. That's going back to signs of speculation.
So this is just it's one house down the street from us. Sold on the first day. Someone put an all cash offer, no contingencies, never even saw the house.
Yeah. Well, I think a lot of you know the statistics better than I, Chris, but I think a pretty high percent of all sales are sight unseen, right? They look on the web.
They were,
and you've got some pretty good technology, LiDAR technology, to take a look at what's going on in a lot of these homes, but I can't replace actually going to see the home. Can't be, right?
Yeah, that's right. Yeah, so there's certainly signs there. That's why. I think they're good to be cautious here and concerned, but I don't know that we're in for a sudden crash. And I hang my hat on demographics. I think the demographic trends are still very, 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 very favorable. Right, we have all these 30-year-olds. So even at the first sign of prices coming down, there's quite a bit of demand there. So
you're just gonna say millennials will save the day here. Yeah, that's weird to say actually, but okay.
They always do, right? Right.
Oh, by the way, a factoid. I don't know if we ever talked about this, but we, as you can tell, we do a lot of modeling. We model at a metro level, even lower than that, but at a metro level, metropolitan area level, we use that modeling methodology Chris described to identify which markets are overvalued, undervalued, and to what degree. And I think we were doing this work a few weeks ago. I think we saw Vero Beach, Florida, as being the most overvalued market in the country, I believe.
I think that's changed a bit.
That's kind of critical because I have a home in Vero Beach, Florida. So concerned me a little bit, but it goes to some another issue in a lot of the modeling. It's helpful, but it's not proof positive, right? Because everything you need to go. It's really saying, hey, go look at me. What's going on? In the case of Vero, you got a lot of outside money coming in, right? So that kind of cushions your thinking about how over or undervalued it is.
Yeah.
But okay, so no, it's not a bubble.
Not a national bubble.
Yeah.
There might be some local
bubbles. Phoenix might be a bubble. Boise might be a bubble.
Idaho. Yeah.
Yeah. Ryan's neighborhood could be a bubble. Who the hell knows?
But not his house.
Not his house.
No, every house there is overvalued.
Not his house.
Right.
Definitely not a bubble at his house. Yeah. Okay. All right, Ryan, you agree with that? I agree with that.
I would agree.
With me.
Yep.
So stocks, baby bubble, housing, not a bubble yet. By the way, I have a Washington Post op-ed coming out shortly on. Did I send this to you guys on bubbles, housing bubbles?
Nope.
Oh, I'll send it to you. Yeah, because this is where I land in the piece in this op-ed, same place we just landed. Let's now quickly talk about the other market we want to talk about: crypto markets, Bitcoin, Ethereum, stablecoin. Let's throw in NFTs. Okay, is this a bubble? Let's do the checklist. Ryan, you want to go through the checklist?
No, we can just skip the checklist. It's a bubble.
All right.
But, I mean, there's no. This is like the poster child of a bubble.
Well, because
there's
when you
a
say
lot of leverage.
Overvalued, the question becomes, well, where's the value?
What is the value? I don't know what the. Yeah, exactly.
Well, hold on. Let me push back a little bit.
What's the intrinsic value of
Okay, I mean, it does. I mean, the value is that it serves as a payment system for places where the payment system's broken down, right? Like, I am an immigrant working in the Central Valley of California. I want to send money back to my family in El Salvador. right now I got to go down to Western Union, give them my cash. They turn it into a wire. 3 days later, it ends up in El Salvador. They have a big VIG on top of that, and I'm now nervous that my family members come to get Western Union in El Salvador is going to get robbed on the way out.
Right.
That's really pretty bad. But if I have
Oh.
Bitcoin, I can, or Ethereum or whatever it is, I can do this. Yeah, I'm taking some risk here with the value, but I'd much rather take that risk than the risk of getting robbed.
Right.
For the sure thing of handing over, some big chunk of cash to Western Union and I don't mean to pick on Western Union, although I think I should be picking on Western Union. They do charge a pretty hefty fee, for the service. So there's value there, right?
Well, there's value in the service, right? Certainly, but
right.
The coin itself,
the coin
is that an asset? Is that the
Yeah, exactly. And if you look at
Right.
the volatility of Bitcoin
Well-
or these cryptocurrencies, they're extremely volatile.
Well, no, that's not fair because, think about a dollar. If I hold a dollar bill in my hand, that's an asset, right? Although, why would that appreciate in value relative to everything? I mean, it can appreciate, but not like this has been appreciating. But, dollar has
but you're-
value because
yeah.
it serves as a stable source of medium of exchange and is this store of value. It's going to hold its value. But I get your point. Okay, so it's definitely overvalued because we can't really figure out what the value is.
Yeah, the value is zero.
The value is zero. Speculation?
A lot of speculation. You would have to
check.
assume.
Yeah,
Yeah, you can check that one off.
check that one off.
I mean, here's another. I went to the gasoline to the gas station, and there is a Bitcoin ATM next to the regular ATM
Where's this?
right here in Westchester.
No way, really?
Mm-hmm.
not at Wawa? Not at Wawa.
No, no, Wawa.
No, hold on.
ATMs are free of charge at Wawa. So
How does that work? I can stick in my
I have
bank
no-
card and get Bitcoin come out?
I don't know.
Oh,
I'm not touching that thing. I
Can't
don't
be
trust
bad
that.
because
there's
it's-
nothing coming out.
it's $50,000 per Bitcoin. What are they?
Yeah, people are buying like fractions of Bitcoin.
Fractions of Bitcoin.
I'll take a picture next time I'm there.
Yeah, I'd like to see
It's-
that.
It's fascinating. I'm surprised Chris wasn't there.
I haven't
Well,
seen that.
It's his
I have.
kiosk. This is a side business now. Do you see Doritos on the side of the ATM? Look for the
No, yeah,
the
Doritos coin. Yeah.
Doritos coin.
Uh,
Actually, that
No one
has a
wants
nice
that.
ring to it. Yeah. Okay, so overvalued,
Leverage.
speculative leverage. I don't know. There must be.
Yeah.
Well, we saw that big swing in Bitcoin prices, Ethereum prices last weekend around something wacko going on in derivatives related to crypto. So I'm sure there's leverage here. But no one's measuring it as far as I can tell. Someone might be, but I don't know about it.
I hear rumors about people
Rumors.
using their credit cards and taking out consumer loans. Kind of what happened during the .com
Yeah,
era,
right.
right? Remember that home equity loans and
Yeah.
Mm-hmm.
yeah.
But that can't be that
Right.
big a deal, right? Because or maybe all that increase in mortgage debt going into the crypto market. Oh no, that's a conspiracy theory. Yeah. All right. Okay. So we've come to the conclusion this is a bubble, in
Mhm.
that it will therefore high probability of a crash here. This is not going to end. It's hard to see how this ends well. We've come to that conclusion.
Yeah.
Okay. All right. Okay.
We could be
So-
wrong, but
Could be wrong.
yeah,
But the technology has value.
Yeah.
Again, I want to emphasize that. But
And
It's
maybe
true.
that's the value, and that's what has to catch up to the price, right? They figure out new ways to improve the technology so that it truly does solve some of the underlying inherent problems as a medium of exchange and store of value. It becomes truly a currency more broadly,
or the
It is-
technology gets applied to other
or other things.
problems, right?
Yeah. But that doesn't help Bitcoin out, though, does it?
No.
I mean, no.
No. So still,
Yeah. No, to help Bitcoin out, the problems inherent in Bitcoin, like the volatility and all the other things that make it unlikely to become a widely used currency, certainly in the developed world,
Mhm.
that could happen, I suppose. Yeah.
And you see some signs of irrational behavior. If Moody's came to you and said, "We're going to pay you in crypto," would you say yes?
so think about it. He's
Yeah,
taking
boy,
a pause.
Oh my God.
Wow.
I thought it was an immediate no.
Yeah. No. Yeah.
All right, Chris,
I'm only getting
Oh.
tired. That's why it took me a little bit longer to respond. I'm running
Yeah,
out of
you-
juice here.
gotta get your
I
Wawa
was on a
coffee.
high, like as you could tell, 15 minutes ago.
Yeah,
Now I'm crashing.
because you see some professional athletes are getting paid in crypto.
Is that
I've
right?
seen-
Is that right?
yeah. I
Wow.
was like,
Okay, there's
"Hmm."
another sign.
Well, they're risk
Yeah.
takers
Yeah.
by nature, right? So-
Well, yeah,
All right. So I think we concluded housing, not a bubble, but let's watch it. At the current rate of price growth, if sustained, that could be a problem. Stocks, a baby bubble, kind of the early stages of a bubble. If that keeps rising in price, then that's going to be a problem. Crypto, big time bubble. Don't know when that's going down, but it feels like it's going down. Okay. All right, very good. I thought that was a very useful conversation. There's other assets to consider. Maybe we'll do that down the road. We'll come back and reevaluate. But clearly a good discussion. And I think our very first podcast back in April, which I mentioned earlier, was around bubbles, right?
It was.
Yeah. I don't know where we landed then, but
I think pretty much the same place.
same
Yeah.
place. Okay.
Mhm.
All right. Okay. All right. Very good. Anything else before we call it a podcast? No.
Your Twitter account is not a bubble, I take it.
No.
No, people should
There's
subscribe.
real. Are you kidding me? It's undervalued, big time. There's real
All right.
value there. Just listen to my tweets. I am though worried that Ryan's going to crowd me out. So
Wait, did you just say listen to my tweets?
did I say that?
Yeah, we will have to
If I did, I
rewind the
didn't mean
tape.
it.
We could do a
Did
podcast.
you just say
on-
tape?
Oh yeah.
Yeah, that would be a good one for the blooper reel.
Yeah.
All right. All right. I'm tired. We're going to call
All
this
right.
a podcast. Hey, everyone. Thank you so much for listening in. Talk to you next week. Take care now.